Hello all and welcome back. I hope you're doing really well. Thank you again for the love and support on the most recent video. As always, I seriously appreciate it. Let's jump straight into this one. First off, by looking at the equities markets, there's lots of different news has been circulating recently about two very major players in the international banking space, Credit Suisse and Deutsche Bank. Now, the former of the two, Credit Suisse, are the ones that are hitting many headlines at the moment. You may have seen different charts like this hit certain news articles and across different sort of social platforms. And this is their CDS or credit default swaps. Now, a credit default swap itself is effectively an insurance product. It's a derivative. They measure the cost to insure bonds in this case. So a credit default swap for Credit Suisse is the cost to insure their bonds, which has been skyrocketing massively. If you think about any typical insurance policy, like for your phone, home insurance, or car insurance, of course, an increasing insurance price is generally or always tied to the underlying risk that body, the actuary, is going to be seeing in order to insure that product. So for example, a young driver, you're going to pay very high insurance rates on a vehicle because you lack experience, etc., and all the different metrics that they put into those weighted calculations. And something similar here is playing out on the financial derivatives markets for Credit Suisse's bonds. Those credit default swap insurance prices are spiking massively. You can see here to over 505. Now, what this effectively is saying is that the underlying risk in those Credit Suisse bonds is, of course, increasing, and to insure those is increasing in tandem. Now, you may be wondering, why is this happening? This is happening because of those bonds, as I mentioned, also known as a CDS or the CDS spread. Now, the spread is the difference between typically some kind of like risk-free asset like a gilt or a federal bond, a treasury, if you would, and a corporate bond. You may hear the words junk bond rated, AAA, BBB, etc. And obviously those are basically ratings against those corporate bonds in terms of the effectiveness of that firm to pay back not only the par value, but also the coupons, the yield on the bond over time. What we're seeing here is Credit Suisse's CDS spreads are reaching all-time highs and they are spiking massively. Now, in the bond markets, it's very similar to how we'd see in staking pools. There's an inverse relationship between the purchasing or the demand of the bond and the yield of that particular bond. So tons of people are selling those bonds. That pushes up the basis point or the percentage point yield of those bonds because they are looking more and more risky. And that is again leading back to why we're seeing those credit default swaps increasing as well, because the risk is increasing because no one wants them. Effectively, they're selling them off. Loads of this is happening after a news conference from the CEO of Credit Suisse, effectively trying to quell fears about the capital position, the liquidity position of the bank after they'd suffered massive losses in previous years. I think 2021 was the 𝗟𝗚𝗡𝗥𝗡𝗙𝗚 sort of issue they had where they lost billion. I think it was like $5 billion was lost, if not more, in basically a lack of regulation. Now, many of you may be wondering as well, okay, why am I banging on about this? And potentially what impact does this have for the crypto markets? And again, it goes back to what we said before about a risk-off environment. Many of these financial institutions obviously command an awful lot, trillions. In fact, I think the combined value of Deutsche Bank and Credit Suisse's assets under management is somewhere in the region of $2.7 to $2.8 trillion. Of course, majority of that is institutional money. And if you're seeing a risk-off environment to the point of where they don't even want to invest in corporate or government bonds because they are worried about the repayments of those bonds, you're going to see a similar effect in the crypto markets in terms of, why on earth would I buy cryptocurrencies when treasury yields are rising rapidly and I'm no longer being paid that premium to take on that additional risk? So that's where the spillover effect may occur, and we could see further pain throughout not only the equities markets, but spilled over into the cryptos markets directly because of that. And here is that credit default swap that I was talking about again here. For any of those of you who are interested, there's a great article over on Investopedia, but it's effectively an insurance against the default. So in the event that someone doesn't pay of an underlying borrower or debt instrument. Okay then, cool. So that's what's happening in the macro markets at the moment and how potentially it could begin to impact the crypto markets. Of course, as always, my position does not change. I'm still in this for the long term, still aggressively buying cryptocurrency tokens like HBAR, like Quant, like Chainlink, Stellar, etc. The list goes on. More positive news though, banks do want to increase Bitcoin holdings cap to 5% of their capital from 1% over the new Basel Committee rules. All the customers will go somewhere else. And this is effectively banks are saying at the moment under current legislation, they are only allowed to hold cryptocurrency assets up to 1% of their capital due to the inherent risk. They want to increase that by a factor of effectively 5 to 5% of their capital. And of course, this unlocks a ton more liquidity that could flow into these crypto markets. Don't forget, there's a ton of legislation that a lot of these banks are bound by in terms of how risky their asset investments can actually be, as well as their portfolios. And changes in legislation like this that they're pushing for shows that they want to take on some additional risk because they see that the potential yields in the future are very high, i.e. this points to increased growth over the future term for cryptocurrencies. Interesting tweet here as well by Plan B saying Bitcoin miners signal the start of the bull move. This graph is depicting the hash rate of Bitcoin. Whether or not this is actually true, as people have said, effectively you could end up this means of more miners. A lot of this is probably going to be a transition from Ethereum mining across to Bitcoin mining. Of course, that transition from proof of work to proof of stake for Ethereum means mining is completely redundant over on that particular chain. So those miners are going to be looking to move somewhere else, where of course the other major cryptocurrency they can move to is of course Bitcoin. So more miners, more Bitcoin, normally more selling pressure. I spoke about this in depth previously as one of the benefits of the transition of proof of work to proof of stake for Ethereum is they would lose that selling pressure from the miners, who are of course having to sell their mined tokens in order to cover their fees and costs. Something similar is of course happening for Bitcoin. We've got rising energy prices due to the crises we're seeing globally. Those rising energy costs, of course, have to be paid for somehow. And the main way these miners are going to pay for those energy costs is, of course, to sell the Bitcoins they have mined. Of course, that being said, though, majority of this mining and the hash rate does actually take place in countries where there are less regulations and much cheaper energy costs than, say, the United States or the UK, Europe, for example. Cardano's founder as well, Charles Hoskinson, has just said Bitcoin is digital gold. And again, we've seen previous comments about him before regarding Hedera and the governing council and how he wishes he had a similar mechanism. And they're looking into that for the future of ADA. Now he's coming out and backing Bitcoin as potentially being digital gold, an inflation hedge, if you would, for the future. Interesting nonetheless, as he's highly respected across the crypto communities. News just in as well, fashion brand Hugo Boss has announced plans to launch its first ever NFT collection. Again, this goes into what we've said many times before. We're seeing more and more of these different brands enter the crypto spaces, particularly via NFTs, as a means to sell their intellectual property at very high prices. We've seen it with the likes of Nike and Adidas, who have made billions off of their different NFT sales. And this is why we'll be seeing more and more of these fashion brands, these icons, if you will, move into the space, as it's something that they can effectively generate an awful lot of revenue from. And they will take advantage while they can. Again, though, it's great for cryptocurrency exposure as well as their brand exposure. These brands command an awful lot of customers. If they're starting to push cryptocurrency and NFTs through their different marketing and media channels, it speaks to reason that we're going to see another influx potentially in 2023, maybe 2024, into the crypto markets from these sort of younger generations that are more in tune with those different types of marketing channels. Wanted to cover this as well. This was dropped in the Discord server for Earthlings.land yesterday by one of the development team. And it's some images actually being released from the Metaverse game Earthlings.land. So 4 different images here showing what will be happening in game or what it currently looks like. I must admit, this does look incredibly detailed for a Metaverse level game, and it just shows the sheer scope of what Earthlings.land is trying to achieve, and one of the reasons why those NFTs will probably do very well in the future. Of course, I've spoken about their NFTs at length, even talked about some of the mints I participated in, and I will continue to participate in them going forward, because I see there being a high amount of return off those NFTs once the game does go live. Those NFTs will effectively give you bonuses in game for playing the game. This will be a play to earn style Metaverse game as far as I'm aware. And I must admit, it is looking very, very good so far. Incredibly promising, and hopefully we see some more updates from them in the future. ESG assets tokenized on Hedera solve many of the issues industry is facing currently and provide advantages which would be impossible on traditional siloed ESG systems and markets. And again, this is talking about that Hedera tweet. Special thanks to DLT Solutions engineer for this in-depth explanation and renewable energy credit use case demonstration of the ESG public ledger, the Hedera Guardian, which I've spoken about again previously in other videos. Check those out on the channel, talking about what the Hedera Guardian is and what it can facilitate. However, a effective too long didn't read is summarized in here, and of course it's via ServiceNow. So traditional versus tokenized ESG assets. An example of an ESG asset is a carbon offset, a renewable energy certificate, or a GHG emission inventory. And then you've got criticalities, so difficulty to verify from a provenance and audit perspective on a traditional system, the risk of double counting, for example, emissions in a supply chain can be double counted, the risk of greenwashing due to lack of provenance information. The assets are often totally fungible, missing essential information about the project and geography doesn't allow effective offsetting. If you compare that to a tokenized ESG asset system, such as the one that is being built by the likes of ServiceNow and the Guardian on Hedera, these tokenized assets have multiple benefits, such as creating verified supplies of those ESG assets based on the MRV data. You've got carbon inventory through verifiable carbon accounting principles. You can reconcile the information across the supply chain via scopes 1, 2, and 3. You've got discoverability and price determination based on location, quality, and the project, i.e. you've basically got better data information on these different types of assets, which enables you to price them more effectively. You can prevent the double counting because, of course, the GHG benefits by providing verifiable on-ledger offsetting and retiring. And of course, that's because it's fully immutable, stored inside the Hashgraph DLT itself. So these are some of the benefits versus traditional markets. And one of the reasons why this ESG market is a sort of silver quiver in the bow of Hedera in terms of what will be happening in the future with the use cases on Hedera Hashgraph, and how majority of this could be leveraged to access trillion-dollar industries, particularly as the world is moving towards sort of renewables, and things like ESGs and carbon offsetting are incredibly important. I've got another carbon offset video project to look at in just a second. Wanted to throw this in here as it was somewhat interesting, a bit of a relationship and a bit of technical analysis, as many of you know, more macro focused. But we can see HBAR has a 192-day Gann cycle. Notice how the accumulation and distribution indicator spikes nearly every 192 days, just prior to major up or down pivots. So effectively every 192-day cycle, you either see a massive upswing or downswing based on this particular indicator. And if I flick over, that was from a month or so ago. As of yesterday, we can see the HBAR token has just begun a new 192-day Gann cycle. So potentially there could be a large upswing or downswing. Now, personally, I don't think we're going to see a large downswing per se. We've been in this resistance channel for a long, long time, around sort of 5p or 6 or 7 cent range. If anything, it seems more feasible that we'll see an upwards swing. Personally, if there is a large negative swing, fantastic buying opportunity for me. I am all about stacking those Hedera HBAR bags as much as I possibly can in anticipation for that next bull run. I genuinely believe the price appreciation of the HBAR token will be absolute insanity when its full value is completely realized, particularly with a lot of these use cases that we are seeing. Jumping across then to the ecosystem at large, HashPack version 4.3 has just gone live, and that brings those in-wallet token swaps as well as some additional staking information. So as you can see here, as part of this screenshot, there is actually now a new tab in your HashPack wallet called Swap, and from inside this tab you can natively swap tokens from within the wallet window to whatever token you want that's being supported by SaucerSwap. So of course this is effectively using or bringing that SaucerSwap UI directly into HashPack. Now do be aware there is actually a higher fee taking place here. I was in some of the Discord servers and Pluto was saying that effectively they base their additional fees off the MetaMask principles, which is somewhere around 0.8% or 0.7%. On HashPack, they are charging an additional 0.7% fee plus the 0.3% fee for the transaction being routed through SaucerSwap. So you are going to see transaction fees of 1% if you use this feature within the wallet. That being said, this is great for people that are new to the ecosystem or need to trade tokens in a pinch, particularly on mobile, where of course setting up dApps and stuff with the access strings can sometimes be a bit funky. This is still a great feature to have. However, for many of us that are more integrated into the system and have used the SaucerSwap platform before, I'd probably urge you to continue using the SaucerSwap platform because you'll be paying a 0.3% fee instead of a 1% fee. Of course, that is a complete no-brainer. Why spend more when you don't have to? However, props to HashPack for integrating this. This is great for sort of newbies coming into the ecosystem that want to swap tokens really quickly, and it still has a place in helping to build out that infrastructure and the capabilities of these wallet applications. So complete props to the team there. Maybe they'll look at the fees in the future in terms of potentially lowering those, so there is less of an incentive to go and use the SaucerSwap platform if you are in the ecosystem. Just wanted to throw that out there. They've also added a bit more info to the staking flow to help people understand the current state of the node you are staked to, as well as how to make more informed decisions about which node you'd like to stake to. So obviously I covered this in a dedicated video talking about the different staking phases. However, they have now got this information showing directly within the HashPack wallet itself. So you can see at the bottom here, staking is currently in phase 1 and does not pay out rewards. This page will be updated with more information about your rewards once phase 3 starts. In the meantime, staking your HBAR helps secure the network. You've got the network staking info here with a total state to this particular node. The network total state. And then you've got the current node stats. Currently staked 1.15 roughly billion HBAR. You've got the minimum and the maximum there. So just some more information about this. And of course, they'll update it as the phases roll out further, which is great to see. We can also see that they've updated the Hedera SDK. You've got the child transactions now being bundled under the parent transactions on the history page, which is really nice to see. You won't see that all broken out separately, which fills up your history tab. If you make a transaction which includes token associations and different fees, they should all be bundled underneath the parent transaction. And they've also updated the domain lookup package for faster.hbar name resolution. And they've added some more dApps to that dApp browser, as well as part of their token backlog. Great to see the HashPack team still pushing forward their different development part of their roadmap, I should say, and I look forward to seeing more of the features come out in the future, as they are a fantastic team. Talking about ESGs and carbon offsets, some big news has come out as well. Africa's first verifiable emission reduction platform, which of course uses the Hedera Hashgraph public decentralized ledger to track emission reductions, will start trading its first tokens this quarter. The platform will trade tokens generated in Africa. If I flick across, I can't read more of this. Unfortunately, there's a paywall on Bloomberg, but the first African emission reduction platform will begin trading. CNYK is its name, and it will begin to trade in 𝗟𝗓𝗏 biomass tokens this quarter. They plan regenerative agriculture and blue carbon credits. So this first verifiable emission reduction platform, which uses Hedera Hashgraph, will start trading. And the idea is that it's also in talks to trade emission reduction credits from a company that plans to practice regenerative agriculture on 50,000 hectares or 123,550 acres of land in the East African country and blue carbon projects. Again, this is a massive sort of nation scale, effectively, use case for the Hedera Hashgraph DLT, and plays back into that narrative that ServiceNow and that we're looking at in terms of ESG, carbon credits, offsets, renewables. It is a huge thing, and one of the reasons why Hedera Hashgraph stands among, or head and shoulders among the rest, of course, the carbon neutrality of the platform itself via these types of carbon offsets make it a fantastic choice for these types of critical or mission critical applications in order to provide offsets and renewables. SaucerSwap Labs is now on the yield dashboard for DeFi Llama. So another big integration here. If we flick across under pools, home yields for SaucerSwap, you can now see all the different pools, TVL APYs, base APYs, and reward APYs for SaucerSwap on here. So you've got your HBARX, HBAR, Source HBAR, and the rest. Again, this brings further exposure to the Hedera ecosystem, as well as the SaucerSwap platform. In fact, if I click on this, it should take me to the SaucerSwap platform. We're now seeing over $18 million in total value locked, $40 million in trade volume, with 231.5 thousand trades taking place via SaucerSwap. And of course, this will continue to increase as Hedera increases. And we've got the market cap for the Source token there of $5.7 million. Of course, the Source token itself is something that I am interested in. Obviously, I hold a decent amount from those early NFTs, and I will continue to hold them as I think it will do very well into the future. And we see the Source token price up there at 0.022985 cents per token. Anyway, guys, hopefully you enjoyed this video. If you did, leave a like, drop a comment. I try and respond to as many of them as I can. Make sure you're following me over on Twitter. I will be looking at potentially doing a Twitter space very soon with some partners across the Hedera ecosystem. So some other sort of creators, potentially, maybe some NFT projects. I'll see who I can get on board to engage with you guys and get some of your questions answered about Hedera. and everything that's be happening over the next weeks, months, and potentially even years. We'll have a nice discussion over on there. Until the next one, I'll catch you then. Cheers.